In this video, I'm going to compare and contrast a company's balance sheet to its income statement. So let's start with the income statement, and we'll use the company Twitter. So we've got an income statement here. Sometimes it's called statement of operations. Sometimes it's called the P&L statement for profit or loss. And all the amounts are in thousands. And we've got for the year ended December 31st, 2018, but then we also actually have income statements for 2017 and 2016 as well. So we have three different income statements here. But let's just focus on 2018. So we're going to have revenues and we're going to have expenses in our income statement. And in its most basic level, the income statement is telling you the company's profit or loss over the period. Okay, so for the year ended December 31st, 2018, did Twitter have a profit or did it have a loss? And in fact, it had a profit of $1.2 billion, because remember those amounts are in thousands, so that's a little over $1.2 billion of profit. And that's after taking its revenues. Okay, where does Twitter get revenue from? Well, from advertising and also from selling people's data to other companies, to third-party companies. How do I know where it got its revenue from? That's in the notes. In the notes to the financial statements, it talks about revenues, two sources of revenue for Twitter. So we have $3 billion in revenue, but then we added a lot of different expenses. Cost of revenue, which is like their data hosting costs and so forth. There's a note in the financial statement that tells you what cost of revenue is. So you have R&D, sales and marketing. You have all these different expenses here. Okay, so we have these different expenses. So we take our revenue minus our expenses, and then that leads to the profit, which we call net income. And if we have more expenses than revenues, then we will have a loss in parentheses here. So for the year ended December 31st, 2017, Twitter lost a little over $100 million. And then almost $500 million they lost during 2016. Now, notice, again, this is a distinction. There are a couple distinctions between the income statement and the balance sheet. I'm going to talk about the balance sheet in a minute. Again, this is for the year ended, so this means over the entire course of 2018, from January 1st of 2018 to December 31st of 2018, Twitter had a little over $3 billion in revenue. So that's not as of a specific point in time. This is for a period. This is for a 12-month period. They had a little over $3 billion in revenue. So that's one distinction, because the balance sheet is going to be a point in time. So the balance sheet is a point in time, and the income statement is for a period of time. So when we get to our balance sheet, it's going to say as of December 31st, 2018. So it's a snapshot of a point in time. But this is for an entire period, the revenues and expenses for Twitter. Another difference is this revenue account, and all the accounts here, expenses and so forth, but this revenue account, let's take that. We are going to zero it out. And for 2019, Twitter is going to zero out that account. What does that mean? It means that they're going to have to close it. They're going to close out that account. So they're basically, revenue normally increases with a credit. So they're going to debit revenue for this amount, a little over $3 billion, and then they're going to credit retained earnings. So you're going to close out. So all these accounts, revenues and expense accounts, these are called temporary accounts. They're temporary because we zero them out after we make the financial statements. And you say, why would we do that? Well, at the beginning of 2019, January 1st, 2019 at 12:01 a.m., Twitter has zero revenue for 2019. So we just want to track the revenues and expenses for a period, and then we zero them out at the end of the period to start the new year. Okay, so if you ask for any company at the beginning of their new fiscal year, what's the sales revenue? It should be zero, because we want to start that year. So this revenue amount is just for 2018. It's not telling us about revenues that happened in prior years or anything like that, just for the year ended December 31st, 2018. Now, let's take a look at the balance sheet. So the balance sheet is going to have a lot more accounts. We're going to have assets. We're going to have liabilities, and then we're going to have stockholders' equity. Those are the three parts of the balance sheet. So we're going to have assets, and they're going to be equal to liabilities plus equity. Okay, so we've got our total assets here, and we've got two balance sheets. We don't have three. We have three income statements, but we only have two balance sheets. So that's pretty common. December 31st, 2018, and this is as of that date. What does that mean? Well, we have cash and cash equivalents of just shy of $1.9 billion here. So that means they have a little under $1.9 billion of cash and cash equivalents on December 31st, 2018. That might have been different on December 30th or December 29th. So this is a snapshot of a certain point in time and saying, okay, what are the short-term investments on this date right here? It's not telling you for a period, it's telling you for a point in time. So that's a distinction between the balance sheet and the income statement. Again, the balance sheet is a point in time. This date right here, how much cash do we have? Whereas the income statement was telling you the revenues and expenses over the period, over the course of 2018. Now, well, assets, liabilities, and equity. Remember, assets are things that the company owns or controls that provide future economic benefit. Okay, so we've got cash, we've got investments, accounts receivable, that's money due to the company, and we're going to have it broken out into, we've got our current assets, and then we've got our non-current assets, things like property, plant, and equipment, and so forth. All of these accounts here, and then also we've got our liability accounts and our equity accounts, all of these accounts are what are called permanent accounts. So I'm going to write that permanent accounts. So remember when I said with the income statement, we zero out the revenue and expense accounts at the end of the period? We do not do that with balance sheet accounts. For example, cash and cash equivalents, that $1.894 billion, you're not going to zero that out. You're not going to say, well, it's the end of the period, let's zero out the cash account, right? So you're not going to do that. You're not going to zero out the short-term investments. The accounts can change from one balance sheet date to the next, and we see that they do, but you don't say, well, it's the end of the period, let's zero out the property, plant, and equipment. So these are permanent accounts. So this is telling you the cash and cash equivalents ever since Twitter had become incorporated. They have been tracking their cash balance of cash and cash equivalents, and this is the balance as of this date. Okay, so it's not tracked just for a period. It's just of that point in time. So we've got all our different permanent accounts here, and the balance sheet tends to be more helpful when the company is in financial distress. And if you're, for example, thinking, oh, they're going to go bankrupt potentially, then you might say, okay, well, what assets do they have? Now, remember, these assets are not all valued at fair value. Some of them might be valued at their fair value, like investments, but some of them are not valued at their fair value. And so like property, plant, and equipment is not valued as fair value. So it might have a value in a bankruptcy much higher than $885 million. We don't know. Now, some assets like goodwill, they're not going to have any value in a bankruptcy. So investors tend to focus on the income statement more when the company and it's just normal operations, the company is doing well, and they're focusing on the income, and they're saying, okay, over the course of 2018, did the company have a profit? Did it have a loss? And so forth. And that's going to actually affect the balance sheet as well. That's going to affect the balance sheet through this account right here called accumulated deficit, which is what we call retained earnings when the retained earnings account is negative, when it has a debit balance. So retained earnings is just all the profits the company has ever earned throughout its life, minus any dividends distributed. There's a little bit, it's a little more complicated than that, but that's the basic idea. And accumulated deficit means that, okay, Twitter had accumulated more losses than it had profits. So we have you just change the name of it to accumulated deficit. Now notice something, that accumulated deficit went from 2.6 billion down to 1.4 billion. So the accumulated deficit got a lot smaller over the course of the period. So if you look and you wonder why is that the case? Well, here is the 2018 net income. And so Twitter had over $1.2 billion profit. And so that is going to decrease the accumulated deficit from 2.6 billion to 1.4. Now, if you're very astute, you might notice that this number minus this number does not equal this number right here. It's close, but it's not exactly equal. And if you go to the notes, you'll see that there was also the accumulated deficit account was affected by an accounting rule change for the new revenue recognition rule. So sometimes this accumulated deficit account is affected by things other than the company's profit or loss and dividends. But in any event, the income statement and balance sheet, these are connected in that the net income or loss from the income statement is going to affect the accumulated deficit in this case, but for most companies that have a retained earnings account, the net income or loss is going to affect the retained earnings account on the balance sheet. So the balance sheet changes from one balance sheet date to the next. We have a new retained earnings, in this case accumulated deficit account, and that is affected by the profit or loss. So if the company has a profit, then that will increase the retained earnings or reduce the accumulated deficit from period to period. So to summarize, we've got the balance sheet, which is tracking the company's assets, liabilities, and stockholder equity accounts over time, and it's giving us, as of a specific date and time, what is the balance of all those different accounts, which are permanent accounts, and the company will always be tracking them. It will never zero them out. Okay. But the income statement is looking at over a specific period of time. It's looking at a period. It's saying, what is the company's profit or loss? And then it tracks that profit and says, oh, they have $1.2 billion of profit. And then they zero out the accounts. And you wonder, what happens to all those accounts that got deliberately zeroed out? We transfer them to accumulated deficit, aka the retained earnings account.